cute kind of zero-sum game. Their ability to do that and do it well, that's an interesting concept. Whether that tactical will work, I guess we'll find out in the future. Only time will tell. And the other thing that they've talked about is low volatility investments. And I mentioned up front that 2005 was a bit of a sea change, or the scales have been balanced a bit differently. And what happened in 2005 is, from a U.S. corporate defined benefit pension plan, what happened is there's evidence to show that what they realized was that more than 50% of the pension beneficiaries in U.S. corporate defined benefit pension plans no longer worked at the company. They had retired and moved on somewhere else. So as a corporate plan, you think you're offering a benefit to your employees. They're not actually benefiting from it. They don't care much about it. And you have a risk in terms of balance sheet and income from an underfunded status, from a hit to earnings status on managing this for something that you're not even doing on behalf of your own employees. So it's my belief, it's our belief, that when funded status improves and rates improve, you'll see an incredible acceleration of the liability-driven investment approach, particularly for corporate pension plans around the globe. So think mature markets like the US, the UK, and the Netherlands. So what's a conversation at a conference these days, particularly a trading conference or an asset management conference, without a little discussion about regulation? So also within this survey, 68% of the survey participants believed that there would be more regulation in the future, and that regulation changes that are currently in the pipeline will have a major impact on the asset management business in three distinct ways in which I've already highlighted from a trend perspective. So 53% of the survey participants had said that they expect more M&A activity. We talked a lot about that earlier on. 55% expect continuation of fee compression. We talked about that from a pricing pressure and profitability standpoint. And 40% of survey participants said that they expect the continuation of the decoupling between investment management, the manufacturing, and distribution. There have been a variety of deals over the last 5 to 10 years that have kind of segregated those two components of asset management. So what is likely to happen from that standpoint? What scenarios are likely to occur within asset management? Well, through this survey, there were three distinct views that had occurred. About 34% of the survey participants felt as though the industry would move towards a commoditized model. So regulation would result in liquid products, low-cost products, simple products, transparent, indexing products, and pricing pressures would put pricing pressure on the economics of asset managers. You'd see a talent drain as a result, and you'd get a commoditized industry. About 34% of the people thought that that was the likely future of asset management. About 17%, the optimists in the room, felt like the industry would result in a vibrant scenario. And here is where asset managers rise up and create investment solutions and not products for clients that they believe better align their interests with their client interest, that those fees are more aligned with the client's interest and their own interest, and they're more of a solutions provider than a product pusher. About 17% of the folks thought that the vibrant scenario was likely to occur, and the remaining 49% felt like it was going to be somewhere in between, about segmented industry. So what is our kind of conclusions from that? Competition is going to continue to intensify. Scale players, in our view, have a competitive advantage. Asset managers need to better align their fees and their interests with those of the clients through a solutions-oriented approach and not a product approach. We think that that's happening, and that the acceleration of some of the trends that I've talked about, largely since 2005, are likely to lead to that segmented scenario, in my opinion. With that, I'm going to just conclude. So who are the winners from an asset management perspective? Certainly the last few years has really accelerated the evolution of the asset management industry. So some of these things were occurring already, but certainly the evolution is picking up its pace. From my perspective, asset managers that are able to develop strategies that meet their changing needs of their investors is going to be important. Success will be able for clients that offer clear, relevant, and compelling solutions, not products, to their clients. Asset managers are going to need to sharpen their focus. They can't be all things to all people, and they need to have a model that's pretty lean and efficient from an operating structure perspective. If you're able to do those few things, I think that asset management, those that are able to do them, will be successful from that standpoint. John, I'm not sure I'm happy to take questions at this time.
I think we're probably a little tight for time,
okay,
Mike, but thank you very much indeed.
Great, thank you.
And let's ask you to grab your keypads again, if you would, for our last little set of questions, and here they are. Do you think the flurry of exchange mergers will do one of those things? 1, 2, 3, and 4. And there we go. Decreased liquidity, remain about the same. You're undecided, pretty much. Thank you for that. The next one, and this takes us incidentally to our next presentation. The flash crash committee suggested, and so on and so on. Do you think they should be restricted in some way? Yes or no? Man who knows a bit about that is Larry Tabb. He's the founder and CEO of Tabb Group. Would you welcome him, please, Larry?
Thanks, John. Thank you, everyone. I've been asked to talk, I guess my presentation is here, a little bit about the flash crash. And I've been given just about as much time as the flash crash actually took. They want me to talk in about 20 minutes, so I'm going to kind of move through this fairly quickly so that we get to the panel and you guys can get the lunch. So we'll talk about a little bit about what happened, why it happened, how do we fix this, and some of the downsides of fixing it. And we'll kind of walk through it on a step-by-step basis. But really to understand kind of where we are and what happened, we really need to understand a little about what was going on in the marketplace during this whole time. The first thing, if you look at, even if we go back to beginning of 2008, in the U.S. equities markets, we've seen a tremendous draining of liquidity out of the U.S. equities markets. And up to now, even if almost a year past the flash crash, we're looking at almost $250 billion being pulled out of the U.S. equities market. So, we're not tremendously flush. And this isn't just decline in market cap. This is actually people, withdrawing funds from the U.S. equities market. So fewer people in U.S. equities, people moving into fixed income strategies, people worried about the global economy, don't necessarily think that growth is going to be a factor. And basically reallocating their capital to fixed income, reallocating their capital to Asia. Those were really the two major places that people were putting money, and besides, and under their mattress. The second issue we've got is hand in hand with declining assets in U.S. equities, we've got declining volumes in U.S. equities, and not just minor volumes. If you go back basically 2.5 years or so, we've seen pretty much major volume declines on a month-by-month basis, and really, from January 2008, just the only actual increasing volume month was the month of the flash crash, and that was, mostly turmoil-oriented trading. Again, literally almost down, 20% on a year-over-year basis, month-by-month. So again, not just, investors sucking money out of the assets out of the equities markets, traders declining the velocity of their trading and reducing liquidity. The other thing we've got going on is that the algorithms and to a certain extent high-frequency traders are providing an increasing proportion of liquidity. And to a certain extent, machines are dictating where our orders go. And so you see, this is kind of liquidity of different stripes. So it's NASDAQ, New York, Archipelago, BATS, Direct Edge, the combination of dark pools and internalizations. And what you see is kind of a coming together of all the different markets. So it really doesn't, it's not like I'm going to place an order on the New York or I'm going to go place an order on NASDAQ. It's now a smart order router saying, okay, where's the liquidity? I don't really care where it trades. Let me just go try and find it. And so what we see is that the liquidity is not just concentrated in one or two exchanges anymore, it's spread out over a wide, diverse body. And that's important when you start looking at where limit orders go and how liquidity stacks up. And if you, all of a sudden you've got a sharp decline, what's going to cushion it? Is it going to just be cushioned because all the limit orders are in one place, or are the limit orders spread out and one book can all of a sudden drop like a knife, and then that's going to trigger fall off across the board? And I think we saw a lot of that occur. And then, of course, we have the flash crash. Huge dip, and then we'll talk about that. So if we look at what happened, in terms of the timeline, we're at 1 o'clock or so. We've got, riots in Greece. You're starting to see fires. We're starting to see all sorts of really nasty stuff on the news. So, this isn't good, especially if you're sitting on a trading desk. You don't want to say, oh, what's going on in Greece? What's happening? Do I want to go shift my money out of equities and more into fixed income? Maybe I don't really want to be trading this market, and the market's getting kind of flaky. You wind up, at 2:30, the VIX is up 22.5%. All of a sudden, there's a lot of volatility in the market, of course, because Greece is burning, and so there's all sorts of different volatility. E-mini buy-side liquidity is off 55%. So you also have to understand that the E-mini, the S&P 500 future is going to be the leading product that trades. Because if I want to get in or get out of the market really quickly, I'm going to the future side. I can sell the S&P 500 in a heartbeat, whereas if I'm going to go try and sell 500 names, or if I'm going to go try and find liquidity for each of those stocks, it's a lot harder. So I sell the future, I sell the ETF, I sell the commodity-based products, and then wait till I can actually get out of the stock and then buy back the future. So that typically is what happens. So there's a lot of selling pressure. So now all of a sudden you've got this infamous buy-side firm that sells 75,000 E-mini contracts in the futures pit, which is basically plus $4 billion worth of equity volume into a very flaky market. Now, the joint SEC CFTC paper basically blamed a lot of it on them. You can't really, it was kind of a flaky market structure. That's the real problem. But on the other hand, you don't really want to put that much liquidity into a flaky market either. So, and also there's a challenge with some of the algorithm, the way it was set, but we'll get into that in a little bit. Now all of a sudden, all sorts of stuff starts happening as this 75,000 contract starts coming into the market. The HFTs basically start buying up, basically selling or buying the futures from the guy selling them. And so what happens first is the HFTs start trading around between each other and basically trying to say, okay, I'll take it, you take it, I'll take it, you take it. Then what happens is you start arbitraging that back into the equities markets, and they start buying the future and start selling the cash. And that then all of a sudden starts putting selling pressure on the cash securities. But in the initial couple of minutes or a couple of seconds, you've got a lot of HFT volume going on. And a lot of it is just happening just between the HFT guys in and among itself trying to absorb this liquidity, but they can't find the other side of the trade. So as volume picks up, as I said, so does algo selling into the equities markets. Let's lay this off into the cash markets. I don't want to touch it. Then you've got the 244, just a couple of minutes in, E-minis down 3%. And so you've got 27,000 E-mini contracts changing hands, buying and selling, with really only a nominal 200 contracts that actually change. So if you add up all the sells, you add up all the buys, you net them out, there's really only 200 contracts difference when there's 75,000 contracts actually being traded. So there's a lot of, or 27,000 contracts being traded. There's a lot of back and forth going on. And so everything starts getting really flaky. So because of the selling pressure, you've got the HFTs hitting their credit limit because the market is plummeting. You've got the New York Stock Exchange hitting LRPs. You've got the CME hitting the circuit breaker. So things start shutting down. Just basically, or the things with circuit breakers start shutting down. So the CME stops trading. New York stops trading certain names. But because not all the circuit breakers were implemented evenly, some of the other U.S. markets were open. But that then left the limit orders in New York kind of isolated and out of the market because that whole market was shut. And so you wind up with, people continuing selling pressure. You've got limit orders that would normally buoy the market. They're trapped. The New York shut down, and then things start going haywire from there. One of the other big issues is a big internalizer. Internalizers, basically take in retail flow, they buy it, and then we'll sell it out a little later. They decided that, okay, you know what, this is all screwed up. I can't figure out what's going on. They stopped internalizing their order flow, and they started turning on the spigot for every single order just to go directly into the market. As the market falls, all these limit orders get triggered. They become market orders and start selling into the market. And all of a sudden, you wind up with basically all these knives falling, and nobody really wants to buy. E-mini down 1.7% to low. The CME shuts down. The CME finally opens back up. Some guys start buying. We start getting a recovery. All of a sudden, things start snapping back. The cash markets start recovering. And then basically in 10 minutes, we traded roughly 2 billion shares, which is pretty huge, which is very huge considering one day, I guess it was a week and a half ago, we only traded 5.5 billion shares the whole day. So a lot of stuff going on. And then FINRA comes back in the next day and says, you know what, all those trades that you did at obscenely low prices, you know what, forget about them. They're clearly erroneous. We're going to cancel them. And then that creates all sorts of problems for the guys who actually bought, because the guys who bought at the lows kind of sacrificed their cash, took a risk, basically traded out of it at a locked-in position. And then all of a sudden, FINRA comes in and says, "Oh no, that buy is no good. That's an illegal trade or a clearly erroneous trade." But on the other hand, they sold, so now all of a sudden they're short. The stock's back up. They've got to cover it at a large, at a higher price, and they wind up hosed. So clearly, a whole lot of stuff went wrong. So what can we do? So if we look at step by step, so clearly what we've got going on here is that a buy-side firm puts a very large order into the market at a flaky time with the algo that may or may not have been, adequately, or appropriate algorithm. So there's proposals basically to have algos checked by a regulator or a competent authority. There's been a lot of talk about this. The CFTC has recommended it. In MiFID II, there's a recommendation that all the algorithms get checked. Personally, I think this is not going to be able to be done. Considering that virtually every single transaction is put into the market by a computer, and a lot of the models get changed on a frequent basis. So who's going to vet these things? How are they going to get vetted? Does the SEC want to be responsible to say, okay, yeah, I vetted Larry's algorithm, and the next day Larry's algorithm blows up, and I said, well, hey, the SEC vetted it. I'm going to go sue the SEC. Do they want to be in the position of blessing every algo? And then the question is, how long it's going to take for that algo to get blessed, and will the market have changed by the time it takes the SEC to bless all those algorithms? I think a much better approach is really direct access rules and just making sure that I have the cash to cover every trade that I execute, and then if I get close to my credit limit, cut me off or tell me to start reversing my position. So whether my algo works or not, whether it's in the market or not, who cares? Do I have the money to cover the trades that I'm executing? That's the real question, and that I think is something that we can actually do. High frequency trading regulation. There are all sorts of proposals to, even though the HFTs weren't quote unquote at fault here, their issues are, should there be incentives for the HFTs to be in more in the market more of the time? What happens when they pull their liquidity? We should mandate those guys, if they want to be in their good times, they got to be in there in the bad times. Again, I think kind of misguided rules. I think the issue is, because to the extent that we provide incentives for these guys to be here, will they really be there if the market is that flaky? And then on the other hand, okay, so if we have really market shocks, 1987, May 6th, okay, one every 10, 15 years, let's just call it 10 years, 2,500 trading days, do I want to be, as an investor, paying a tax to a market maker, an HFT, for 2,499 days for the one day that nobody understands what's going on in the market? And will they actually be there that one day? And my guess would be no. I would think that they would want to pay the fine, take the abuse, but be there to trade the next day instead of stepping in, catching the falling knife, and possibly bankrupting the business. So I think that's kind of a challenge as well. Uneven implementation of circuit breakers. This is absolutely a challenge. CME shut down. CME was okay. New York shut down. That was okay. The other markets didn't shut down, and all of a sudden we have all sorts of crazy prices, and that goes also in line with stub quotes and market maker obligations, and there are a whole bunch of issues there. I'm not going to get into every detail there, but clearly we need to straighten that out. We need to have a way, if one market shuts down, they all shut down. Or to a certain extent, I think what the SEC is looking at now is a limit up, limit down, so that the markets don't shut down as frequently. If an erroneous price comes in and it's X% below the market, it's just ignored. Instead of basically having to shut the market down and then restart it up 5 minutes later. But clearly, we could do stuff here, and I think that everybody agrees that it's okay. One of the more interesting issues really has to do with this whole issue of internalization. We've got internalized trades. All of a sudden, the internalizer doesn't want them anymore, throws all these orders into the market, have all these market orders all of a sudden trip out all the stub quotes. And so there's issues around here. Do I want to create a central limit order book where I have complete depth of book, trade protection across all the different markets? Do I want to all of a sudden say, create a trade at rule, which basically says I have to direct my order to the most, to the market at the best price? Do I want to say that there's no more, dark matching of liquidity unless there's significant price improvement? And all of these are up in the CFTC SEC joint recommendation. A lot of these proposals are interesting. However, I think there's going to be a lot of pushback from a lot of people. Certainly, the institutional investors, like dark liquidity because to a certain extent the markets are pretty, are pretty competitive and pretty tough, and the institutional investors like to hide in the dark pools. So if they try to close off the dark pools or thin the dark pools down, that puts more orders into the main market. If the main market is dominated by people who are going to rip my face off, that's not a good thing. On the other hand, if we can create a safer market infrastructure where institutional investors can actually, trade more effectively without getting their faces ripped off, I think people would like that. Also, getting more retail order flow into the market, I think, would be a better thing for institutional investors. But there are very challenging. You can't just fix. You just can't drain the dark pools without fixing the market structure issues, and they're very complicated issues here, and it's steeped in politics. So I don't think you can do trade at without doing parity, basically getting rid of payment for order flow and getting more retail flow in the market. And there's some very powerful political constituents, and I'm not even sure it's the right thing to do either, because you do chase a lot of liquidity out. So I don't think there's going to be a whole lot done creating really a central limit order book, consolidating the dark pools, getting more flow onto the exchanges. I think that will get mired in challenge there. But I think it's a good discussion. The other thing, and this slide really talks about that actually the stub quote issue, the penny trade issues actually happened after the bottom of the market. And so this goes back to actually this internalization thing, that all of a sudden the market wigs out, and then all these internalized orders I shut down, I start sending them all to market, and actually the market is coming up, and I've just shut my system down. And so what you have is, the liquidity has been drained, and you have all this pounding of these less liquid stocks and ETFs that's happening actually after the market has rebounded, or starting to rebound, which is interesting, which gets back to the internalization issues. And FINRA broke, thousands of trades, and I think once we get into the issues around creating effective limit up, limit down, and circuit breakers across the board, this issue will wind up going away. So, but FINRA clearly needs to fix this, and we shouldn't be breaking trades. So what's been done post-flash crash? We've implemented short sale curves, circuit breakers. We've tightened market-making quoting. We've debated better rules for clearly erroneous. Hopefully they'll go away with the circuit breakers. And we've published a report saying that the culprit is one of you guys, a big trader who just put in a stupid order, which I think is actually not the right thing to do. It's really the market structure that's a challenge. Other rules that are in process, the market access rule, basically pre-trade risk checking, and I think to a certain extent I think that's really good. I think if we can create a better risk management process, both pre and post, I think that will help a lot. And again, discussing transitioning circuit breakers to limit orders. What's under discussion? The vetting of algorithms, time and force quoting for market makers, which I'm not for either of those things. Market maker incentives, I'm really not for that either, because again, the incentives come out of the investor's pocket, and the day you actually need them, they probably won't be there. Reallocating the cost of the infrastructure to HFT firms in terms of quoting. I think what that will wind up doing again will probably be to widen the quote. Any type of cost you wind up implementing on market makers, they'll be fine with it. They'll say, okay, you want to raise my price of trading? That's fine. I'll just widen my quote, and it'll get transferred back to the end investor at the end of the day. Parity and trade at, interesting ideas. Love to see them better modeled. I think there's a lot of political pressure against both of those issues, and that's again payment for order flow and trade at, which is basically saying that you can't match the bid-ask spread. You got to better the bid-ask spread if you want to match it off exchange at better than and it's basically better than a half cent. And the audit trail, I think we really do need to give the CFTC and the SEC and the regulators a better idea of what's going on in the market. Now that said, the SEC proposal for an audit trail was $4 billion with $2 billion of, to run it on a yearly basis, which I think is insane. I think, maybe 10% of that, 100% of that, I don't think there's any reason to spend $4 billion on an audit trail. But clearly they need better tools and better technology budgets. And so what are the easy things? Certainly circuit breakers and limits, jawbone the market makers to create tighter quoting spreads, consistent trade break policy, again. What are the more medium things? The direct access rules, trying to get the risk management right. Post-trade risk with a quick kill, which I think is actually the most effective type of risk control. So, okay, instead of vetting every single 100% of my orders before they get executed, if I have a 98% kill ratio, I'm vetting 98% of trades that never get executed. I'm only going to vet, the only 2 of those trades are going to wind up getting executed. So if you do it on an after-the-fact basis, you actually have a better, better and more data, but it's a little bit more challenging. Consolidated order trail and greater capital for clearing firms, which I think that's a good thing. The hard stuff I think is the trade at and parity rules. And creating a central limit order book, I think that'll be really problematic. Impossible, impractical, or not desired. Market maker incentives, as I talked about. Algo vetting, I talked about. Transaction taxes or HFT transactions, I think those costs just get reallocated to investors. And wider minimum spreads. Now, wider minimum spreads for small caps, that's a different story, but wider minimum spreads for traditional stocks, I don't think we need. And with that, I think I went a little long.
Thank you very much indeed, Larry. Come and join us.